Hi there, Brock VandenBerg, President of TaliMar Financial. Today, I want to go over April numbers with everyone. Just right off the cuff, we had another great month. Not only did we see loan origination increase, we saw the health of our portfolio remain extremely strong. We are actually in the process of expanding our team, and we're seeing the mortgage fund continue to grow. So in just a minute, I'm going to go ahead and go to the numbers, go through a quick PowerPoint presentation on the health of the mortgage fund and what we're seeing in the marketplace. But before I get too far, I want to remind everybody, number one, like this video, and then number two, subscribe to our YouTube station. I post a ton of great content on investing in trust deeds, investing in the mortgage fund. I do provide tips on how to look at trust deed investments if you're looking at investments outside of TaliMar Financial. So go ahead and again, like this video and subscribe to our station. So let's go ahead and take a look at the numbers. All right, so as I mentioned earlier, April 2022 was another great month for TaliMar Financial. Our focus going into last month was number one, to increase the amount of capital in the mortgage fund. We had a success there. Number two, increase the loan volume that we did from the prior month and then from the prior year during the same period. We did that. Number three, to maintain an extremely healthy portfolio of existing loans. We did that. And then four, our focus was to increase the number of team members on our team. As the mortgage fund grows, we're looking to bring in more people on the portfolio management side, as well as bringing in new loan originators to assist us with all the new capital that's coming in. So let's go ahead and take a look at April 2022. So first thing I want to start off with is the successes of the month. First success is we funded 16 loans in April, totaling almost $8 million. I would say that my team right now, we're good about funding between around 15 to 20 loans in a given month. That really depends on if they are going to be funded by trust deed investors or by the mortgage fund. I know I continue to talk about how the mortgage fund is a much more efficient process for the company to fund loans in. It truly is. And so it allows us to do more loans, it allows us to do better loans, and allows us to do bigger loans. The second big success is we did exceed 55 million in assets under management. That's a combination of both the mortgage fund, which we have roughly 15 million in, and then individual trust deeds that we manage, which is about 40 million. Now, as a percentage or ratio the mortgage fund has of total assets under management, that continues to increase. Total investor capital in the fund exceeded 14 million. So we're actually through almost through our first full 12 months of the mortgage fund, and we are on pace in what we had anticipated in moving investors from the trust deed platform into the mortgage fund platform. Number four, we had 30 loans in the fund totaling 15.5 million. And so that fund continues to grow. And then I think most important that we're focused on right now is our existing loan portfolio, where we had no late payments in April and no loan defaults. And it appears that's going to be the same going into May as well. So a lot of successes. We're hoping to leverage all the successes we've had to continue to grow the mortgage fund and be an alternative investment for investors that are looking to diversify into more cash flowing type investments. All right, so let's look at loan origination. What you'll see here in statistics, as I mentioned, we funded 16 loans totaling 7.2 million. That compares with the prior month where we funded 16 loans totaling over roughly 6.8 million. Now, let's compare that to the prior year. So in April of 2021, we funded 7 loans totaling 4.2 million. So essentially doubled the number of loans we funded, and what we were up by 70 to 80% in terms of total loan amount that we funded from this time last year. And then funding year to date, we have funded a total of 47 loans, totaling over 23 million. And again, that's probably about a 30% increase from a comparison of this time last year. All right, let's dial in on the loan type that we funded in April 2022. So again, our primary focus is that fix and flip, fix and hold loan. I love that loan. Borrowers intending to purchase the property, tends to add value to it and then sells it. There's a clear exit strategy. I look at it as, number one, the risk is on the front end. Renovations should get done. As soon as those renovations are completed, that property is a fully renovated house on the market. There's nothing better than a fully renovated house for sale on the market. We have seen a kind of trend more to a fix and hold loan program as more and more loans or borrowers have availability of capital to refinance their existing projects, put a tenant in place, and then hold as long-term rentals. I think that strategy has worked from kind of mid last year to maybe about this month. But now, as you see rates go up on these rental loans, that it doesn't make as much sense from a cash flow standpoint for our investors to hold the properties. Bridge loans continue to be a great loan. Simply, it's based upon current value. Borrower just needs a short-term loan to either purchase the property or maybe pay off an existing hard money loan. Super easy to underwrite and very clean to close in most cases. We did 3 loans there for totaling of 1.6 million. We did one new construction loan. Now, this isn't really a true construction loan. There was an existing property existing house on the property. They were building an ADU on the back. So right now, I would say that we're not really focused on doing new construction loans, as I kind of mentioned and alluded to in the past about where I think construction costs are going. Being that we are dealing with a massively inflationary economy, I think construction loans are high risk because you really don't know what the true cost of that project is going to be 6 months from now. It works great in a market where housing values continue to increase, but if you start to see housing level off, it's hard to re-underwrite if the borrower needs to come back and get more money for the construction loan. And then our 30-year rental loan. So as I mentioned earlier, a lot of our borrowers are transitioning from selling the property into more of a long-term rental and hold as cash flow. It's been a great option for them up until about this month. And again, now rates are starting to creep up on those. So we're starting to see that 30-year rental loan, that volume to decline. All right, so let's talk about loan servicing. Again, this is really one of the focal points that we have here at TaliMar Financial. You know, it's not just enough to do the underwriting and ensure that it's a good loan that we're closing on, but half the battle really is to maintain that loan portfolio. That means aggressive on loan collections. If there's any modifications that need to be done onto that loan, ensure that loan, we're not adding more risk to the loan. And then just kind of make sure that you're understanding kind of where your loan portfolio is in general. You don't have too much risk in any one location or any one borrower that might jeopardize the entire loan portfolio. So I mentioned earlier, our loan portfolio continues to grow at a good, steady, solid pace. Right now, at the end of April, we had 99 loans. We actually exceeded 100 loans during the month. I think we had 3 or 4 payoffs. Current balance of the total portfolio, that includes both the mortgage fund and individual trustees, is at 54.5 million. That is generally on the much higher end of what we have done in the past. Average loan size is around 550,000. That's a great amount to be at. As I grow the portfolio, the mortgage fund, I'll be able to go after bigger and bigger loans. But again, you don't want too much exposure to any one loan. Average lender yield is at 7.72%. I know a lot of investors are saying, well, that's not what I'm getting, especially on the individual trustee level. Individual trustees will always pay less than what the mortgage fund pays, just simply to cover the cost that we incur to maintain individual trustees. We do see that lender yield going to be increasing here over the next quarter. I think rates are going to go up. I feel like right now you're starting to see less and less capital in the market, especially from these Wall Street firms. They're a little concerned about where rates are going long term, so they're hesitant to fund new loans. So I think that we're going to see some upward pressure on lender yields. Keep in mind, though, that 7.72% also considers some of the kind of the legacy loans that we have in the portfolio that have higher lender yields, and then also some seconds that we have funded in the past. Average loan to value right now is at 57%, super low. I love that kind of return, 57% loan to value, earning a 7.72% return. I think that's a great return that you're getting for the risk that you're taking. And we have 0 loans in default. All right, let's talk the mortgage fund. So as I mentioned, the mortgage fund continues the amount of capital in the mortgage fund continues to increase. Currently, we have 31 loans in the fund, totaling about $15.65 million. The average loan size is about $504,000, which is kind of in line with what we have in the total portfolio of assets that we manage. Loan to value ratio is at 56.96%, again in line with kind of what the entire loan portfolio is. Really, the intention of this mortgage fund is really kind of follow the same strategies that we have been employing over the last 15 years on the individual trustees. Average April 2022 yield. So we returned an average of 7.25%. That's an annualized yield in April. We did incur some costs associated with year-end taxes and other financials. We should have that all behind us now, and we should see a significant boost in yields. We'll be running those figures and have those funds dispersed. The idea is by the 15th of every month. The trailing 12-month return for the fund is a little under 7.5%. Again, we're just wrapping up our first full year. So as we do that, I'll let you know what the full annualized return of the fund is going to be. So let's dial in on what the mortgage fund. So in our portfolio analysis, if you were to look at the types of loans that we're lending on in the portfolio, obviously you're going to see a huge amount or wide amount of the loans are being secured on single-family residences. We have some exposure to commercial, some to industrial, and some to land. Though I think in kind of the medium term, the fund is going to be heavily focused on doing single-family residential properties. Again, by loan type, about 50% of the portfolio are fix and flip loans. Again, these are loans that the borrower intends to renovate the property and then sell at a future date. That's really been our focus over the last 15 years. In fact, essentially established the company around the idea of our investors buying up single-family houses, renovating, and then selling them. We've done over, I would say we've done over 600 loans that were fix and flip loans. The second is you got your fix and hold loan, same kind of concept, but the borrower intends to renovate it, put a tenant in, and then sell it. And then you've got 23% of the portfolio are bridge loans. And that is just based upon current value. Borrower needs short-term funds to either purchase the property or renovate it. They don't intend to put any significant capital into the property to improve it. It's just simply based upon current value. If you were to look at the mortgage portfolio by county, again, we're heavily concentrated in San Diego. It's a little over 85% of our portfolio. It's my backyard. I can quickly go and take a look at the property. We do most of our marketing in this San Diego marketplace, which is why we get a high concentration of loans in this area. I think San Diego probably has one of the strongest housing markets. You've got not only people from the Bay Area coming and relocating down to San Diego, you just don't have enough housing for the amount of people that are looking for housing here. That's why home values in San Diego have jumped over 30% over the last 12 months. And they're just never going to solve the issue of the housing crisis here in San Diego. And so that's why I like investing in San Diego. I think there's a long-term growth opportunity in this marketplace. Okay, let's take a quick glimpse at what the housing market did last month and over the last year. Generally right now, the housing market in California remains strong. There's no real direct evidence to suggest that the housing market is slowing down. Most core markets, if not every core market in California, suffers from a lack of supply. Too many buyers out there looking for homes. Obviously, that's been helpful with investor buyers out there flooding into the market and looking for long-term investments to purchase. But if you're to take San Diego, I think that, again, we are suffering from a significant housing shortage, and there's nothing that's going to be done here in the short term to alleviate that. Even with these new rules around ADUs, there's no way they're going to be able to build enough housing to meet the demand that's currently here. So bullet point number one, 72% of transactions closed over the asking price. That means 7 out of 10 houses sold over the buyer's original asking price. Just goes to show you how much demand there is for housing. The median days on market for homes sold last month held steady at 11 days. So again, anticipate in markets like San Diego, days on market, usually a good amount of 30 days. So, we're more than half the amount of days on market would be a normalized market. Home prices jumped generally over the last year by 12% in California. There must be some markets that just did not move very well to bring that percentage down, because I know in San Diego, home values jumped by over 30%. Number of homes listed on the market topped 30,000. So you do start to see more housing coming to the market. Does that represent some type of slowdown? Who knows? I still think that there is an exodus of some of the California population moving, so that they're putting their houses on the market. Now, that is a slight increase from the prior year of slightly over 10%. Unemployment remains extremely low. That's one of the signs that I see that the housing market may slow down. I'll tell you, hiring here for the company has been difficult, trying to find the right people. We've had job requirements open for over 6 months. And so it just shows me that unemployment remains low, means the home buyers, you're starting to see a significant increase in salaries, especially amongst dual income households, which is why I think is feeding into this whole idea that home prices are increasing in San Diego. The Federal Reserve is expected to increase rates over 150, we'll call basis points. It's about 1.5% by year end. We just saw them raised by 50 basis points. Today is the 9th, and you're starting to see some of that concern trickle into the general economy. But yet you have not seen any slowdown in the housing market. Let's just see what happens over the next quarter to see if these rate increases, which is what they're supposed to do, is to decrease or start to slow down price appreciation. So again, one of the arguments I make about considering your exposure to certain segments of the economy is that the Fed is telling you to get out of risky assets. They are pulling the amount of money they're willing to lend for investors to buy risky assets. They're pulling that back. So you should consider maybe diversifying investments that are based upon capital appreciation or based upon appreciation into more cash flowing type assets, one being the mortgage fund. And then the 10-year Treasury note surpassed 3% since the first time in 2018. Again, this is driven by the Fed. And as rates go up for housing, the cost of owning a home, if you finance it, will continue to increase, which should slow down the housing market. Okay, let's go ahead and talk about investment focus. So with today's market right now and what's going on with the Fed and rates starting to increase, you really start to have to adjust and make some corrections in what you're focusing on. So the biggest focus or change in focus that we're looking at right now is on short-term loans. And the reason I want to focus on short-term loans versus long-term loans, when I talk about a short-term loan, I'm talking about, kind of staying in that 12 to 18-month term loan versus the 36-month loan, is because I don't know where rates are going to go. So in a declining market, obviously you want to lock in rates on longer-term debt at higher rates. But when rates are going up, you want to make it a short-term loan because you don't know in 6 months or 12 months from now that you can turn that money into a higher rate loan. So might as well keep it short-term and continue to look for higher rate loans, assuming that they have the same risk profile, than trying to lock in a long-term rate. Now, I'm not going to say you're going to go wrong in a 36-month loan right now, especially if you're not leveraging that note or that mortgage fund heavily. You're not going to have any problems. But where you're going to start to have an issue, especially mortgage funds that have a high leverage amount or high leverage for their mortgage fund, you're going to start to get squeezed. So for example, if you're underwriting loans at, let's say, 8%, and your leverage to the fund and the cost of your leverage at that point is 5%, but it's all 36-month notes. Imagine 6 months from now, let's say your leverage goes up to 6% or 7%. Well, that 3% spread that you're earning is getting squeezed every month or every year. And the worst thing that you can be in is where your leverage, what you're paying out, the rate on the leverage is greater than the portfolio amount. Now, obviously that's a worst case scenario, but that's why you want to mitigate that risk by keeping your money in short-term loans, especially if you're a mortgage fund. Now, if you're an individual trust deed investor and you're not leveraging your trust deed, it's not going to be a big issue, other than you're probably, you've locked yourself into a return that you're probably going to do a little better if you were to wait 12 months. Number two, and I've been really talking about this, is you really want to minimize your exposure to construction debt. There's a lot of mortgage funds that have grown super quickly by lending to the construction, to that industry, to that market. The problem that's going on right now is with inflation, construction budgets are getting blown. I mean, we're talking 30 to 40% over budget. Now, that isn't as big of an issue if home values are going up. However, if home values start to remain steady or start to decline, and you're having to rewrite your loan because the borrower is over budget, the amount of equity that you have, your buffer starts to decrease. And so it makes it much difficult to rewrite those loans, especially if you're a mortgage fund manager. And let's say you've got a construction loan that you just want off your balance sheet. Borrower is over budget, and you just tell the borrower, I'm not interested in rewriting this loan, go find another lender. Well, he's going to have a much more difficult time finding another lender. So if you're invested currently in a mortgage fund with a high exposure to, or I would look if you're invested in a fund to see how much construction exposure they have, and you may want to minimize that risk. And then if you're looking to invest in a mortgage or into a construction loan, I probably would look elsewhere until you start to see kind of inflation tamper down. Number three, prioritize borrower ability to pay. That's been one of the mantras I've had over the last 15 years, is to ensure that the borrower can tell me that they can make the payments. I'm really not that hard money lender that is lending to people with really poor credit or doesn't have the ability to show cash flow. I know you can get a little higher of a yield sometimes with those kinds of borrowers, but I'm more focused on ensuring that that borrower has a high likelihood of being able to pay off my loan and make those monthly payments. So I really focus on borrower credit. I think the average credit score amongst our entire portfolio is a little over 700, and then their ability to pay. So hey, can you show me W-2 statements? Can you show me some income statements, tax returns, something to that effect? And then a clear exit strategy. That's why I like fix and flip loans, because the borrower has a real clear exit strategy of how they're going to repay my loan. That's from the sale of the property. What I really don't like doing is, again, going back to the borrower that doesn't have great credit. He's telling you that he's going to be able to clean up his credit, and once he does, he's going to go ahead and refinance the loan. I'll tell you, it never ever happens, at least in my experience. So I like to have that clear exit. Hey, are you selling the property? Are you refinancing the property? If you are refinancing, what is your strategy? Who are you talking to? Do you have a term sheet from that lender that's taking me out of the loan? Fourth item is to recycle investor capital in the mortgage fund. The worst thing I can do is have cash on the balance sheet not earning interest. If you are invested in trust deeds, I mean, imagine the mortgage fund is you and you've got a bucket of cash sitting on your sitting in your account. Well, you constantly want to get that money back out. So that's our focus, is to look at the future and anticipate loan payoffs and be able to then allocate the funds that are going to be paid off into the loans that we're originating. Keep lines of credit under 50% utilization. Again, we don't have a line of credit right now for the mortgage fund. Again, official TaliMar Financial currently provides the mortgage fund a line of credit, so that if we anticipate a payoff and we know we've got a new loan in the future, but that payoff is occurring prior to that new loan being closed, we'll go ahead and lend money to the mortgage fund, close on that loan, and then once the payoff occurs on the other loan, to repay that line of credit. The intention of that line of credit is not to boost the return of the mortgage fund. The other thing that we're looking for is look for increase in days on market, inventory, and late pays. That's going to right now, what's great about the mortgage fund in kind of trust deed investing is it's kind of a canary in the mind, in terms of, we right away we see if there becomes an issue with late payments or maturity defaults. If we start to see days on market increase from the mortgage or from the fix and flip loans, and so we can see it. We don't see it right now, but we're constantly looking at our portfolio to see if there's any changes in just the health of the portfolio, and that'll tell us kind of where the health of the housing market is. So common questions that I'm getting all the time about who we are in the mortgage fund. So as I had mentioned, I started TaliMar Financial in 2008. I was funding investors who were buying houses at the courthouse steps with my own cash, and then I just grew it from there. So as I mentioned, we manage a little under 55 million in total loans right now. That's about 100 loans. And we funded well over 800 loans, totaling over, I think we're almost at 310 million that we have funded. So yeah, say 700 loans. This is a little old now. We service a loan portfolio, again, as I mentioned, 100 loans, totaling over 54 million. And our focus is really residential in really the San Diego market. On that prior slide, that showed you kind of where our exposure is. And that's going to probably remain that way for a good period of time. Now we launched TaliMar Income Fund I in 2001, May of actually last year, and it's been a huge success. I think a lot of investors are starting to recognize the kind of the upside of a mortgage fund. Number one, there's some significant tax savings being in the mortgage fund. Number two, you're diversified over a portfolio of loans. You're not just any one loan. If you're currently a trust deed investor, you understand how difficult it is to get invested into a mortgage fund. There's just a lot of money into trust deeds. There's just a lot of money chasing after these individual trust deeds. So the mortgage fund alleviates that issue. You don't have to chase after trust deeds. You don't have to make a decision, within a matter of minutes if you want to invest in that trust deed. So there are a lot of benefits of that mortgage fund. If you're interested in learning more about the mortgage fund, go to our website at talimarfinancial.com. Just go under the investor tab and you can request a copy of the executive summary on the mortgage fund. So that about does it with our overview of April 2022. As I had mentioned, another huge success for the company. I'm excited for what May is going to offer. I think we're probably looking at between, again, 15 to 20 loans. We should be doing between 8 to 10 million. And I think this mortgage fund will probably be getting closer to around roughly mid 16 to 17 million in total investor capital. If you have any questions about our trust deed platform, the company, or the mortgage fund, feel free to give me a call. I've got my number on the slide. And yeah, look forward to hearing from you. And I appreciate you listening to our month-end slideshow. Again, if you have not already, please like this video, as well as go ahead and subscribe to our station. Thanks so much.